The U.S. dollar remains firm as the U.S.-Israel war with Iran intensifies, with reports of fresh strikes on Tehran and Beirut, evacuation warnings in southern Lebanon, and increasingly hawkish rhetoric from U.S. officials, including Secretary of State Marco Rubio, signaling that the hardest hits may still lie ahead. Iranian media also report damage to U.S.-linked assets in the region, while one major media outlet suggests the next phase of attacks will target Iran's missile, drone, and naval capabilities. Energy markets are firmly bid amid concerns about supply disruption, with oil holding near $80 per barrel and supporting currencies like the Canadian dollar and Norwegian krone, while LNG tanker rates in the Atlantic Basin have reportedly doubled in a day. Broader risk sentiment is softer, with U.S. equity futures in the red, led by a drop in NASDAQ futures, and the U.S. 10-year yield rebounding as investors price renewed inflation risks from elevated crude prices. With a light economic calendar, geopolitical developments and oil will dominate, though Eurozone preliminary February CPI is expected to show a modest uptick in headline inflation alongside steady core readings. Central bank commentary will also be in focus, with Norges Bank hosting a policy conference and Fed and ECB speakers on deck for clues on how the conflict may shape inflation and rate expectations. While overnight, the RBA struck a more hawkish tone, warning patience on inflation has limits and leaving the door open to a near-term hike, helping Aussie dollar hold up better than its peers. That's all for now.